That would be great.
Yeah, very great. Very great, in fact. So today, we are looking at business reorganizations and capital reconstruction. So he has tested this chapter once, so it's a potential area to test. So
which one is capital reconstruction?
Okay, business reorganization and capital reconstruction. We'll be looking at it in, let me not say in detail, briefly, and you understand what it's about. I think it's in corporate reporting also, but then it's also in case study. So when I begin to discuss, I believe you'll remember, because it's something you've done before. You'll just refresh yourself. So 4.0, looking at the purpose. Then 4.1, corporate restructuring. Number 2, unit 2, look at the need for financial restructuring. And the final unit is just 3 units, types of financial restructuring. So what's the purpose of business reorganization and capital reconstruction? The purpose is to explain corporate restructuring, explain the types of financial restructuring, then formulate and evaluate a scheme of arrangement on how to restructure a company. So by way of definition in the first unit, like you ask, what is corporate restructuring? It's giving a new structure. You are trying to rebuild or rearrange a business that has gone downward, a downward trajectory. So instead of letting the business collapse or liquidate and end its going concern, you re-strategize, you restructure, you reorganize it to make it live again. It's like looking at a plant or a flower that is dying as a result of malnourishment or not too much sunlight, and you just say, okay, let me dig around it, manure it, take care of it, maybe change its location for it to live again. And that's what restructuring is about briefly. A significant change in business model is what it culminates in. So you are changing the business model from what it used to be to what it's supposed to be, or what you feel it to be to stay alive. A significant change in management. You could sack all the board, sack all the senior management staff, employ new hands. Also, you could change the financial structure. Maybe it's solely on equity. You have a mix of debt, or you change it to solely debt, depending on what works for the business. Also, the purpose is to improve long-term profitability and shareholder value. So this statement shows that there's been a downward trajectory. There's been a downward, the antecedents of the business in the past has been negative. So you want to improve long-term profitability and shareholder value. So what's the goal of corporate restructuring? Increased efficiency, profitability, competitiveness, and long-term survival, which is very important. So the going concern of the business is threatened. So the goal is to enhance that going concern, culminating in long-term survival. So what triggers capital restructuring? Number 1, like I said, the downward trajectory, negative trend in the past, most of it as a result of loss of market share. Your product or service has lost market share to competitors, reduced profit margin or margins, operating margin low, profitability low, revenue low, the brand is weak, inability to retain talent, staff keep resigning, major market changes that affect the product or service. These are triggers to corporate restructuring. So what are the process you involve in to restructure a company? Redesigning aspects of the corporate entity, the business or the financial structure. So those are the process. You look at the business model and what the finance entails. What do you do to the capital, to the mix of debt and equity? So what are the objectives of corporate restructuring? Is to increase shareholder value. Generally, from the past, maybe shareholder value has been eroded. So you want to increase it, improve it, avoid the business dying, avoid liquidation, also address significant problems or threats. So in what context? You are organizing the business legally. You are reorganizing the ownership of the business. Instead of the current owners losing the business entirely, you reorganize it for better position. Provide value proposition that culminates in value creation, addition, value sustenance, and value maintenance. We also look at the context of operational structures in the day-to-day running of business, restructure it, re-strategize for profitability and better organization. Smith said in 2017 that a successful business should ask these questions. Number one, why? So the first question of why, based on Smith's analysis, is that we're looking at forces making change mandatory. Now, change is the constant in life, depending on factors, internal and external of the business. So you need to sit down to ask, why is this business making losses? Why is it going down? Very important questions. Also, the next question is what? What do we do to avoid the why? What is the necessary shift, the necessary input for success? If you have identified that, then you ask, how do we achieve that? And that's the process to achieve change. The injection of your ideas, resources, and every other input to get the business on the right trajectory. And what is next is building a future plan. Building the future plan. So after asking how, you now take action to build the future plan. Very important. So two main aspects of corporate restructuring is the operational, the day-to-day, then the financial, the funds available for running the business. So operational restructuring involves increasing economic viability of the business model. Increasing economic viability of the business model. So you want to ensure that the business model increases its value and viability in the eyes of consumers or customers. So increasing economic viability, for example, merging with another company, mergers, and also, let's say, acquisitions, mergers with a fellow competitor is a graphical example of operational restructuring. Also, you sell a division of a business. Selling a division is also an example. So, for example, a spare parts division could be sold to a company that needs that. And you could abandon that division or abandon a product line that is not profitable to the entire group. And also cost cutting, like closing particular facilities in the business that are draining the business, that have negative contribution to the business. So these are examples of operational restructuring. And also financial restructuring means improving the firm's capital structure. So in bankruptcy, where a business is filing for bankruptcy to shut down, outlined in the scheme of arrangement or plan of reorganization is the issue of financial restructuring, which involves restructuring assets and liabilities. Assets and liabilities, also looking at the debt to equity to match cash flow needs. Very important. So restructuring financially involves asset and liabilities that you're looking at your debt to equity. What is the percentage of debt and to equity? And these two components of the capital structure, how do they drive, or how did they drive the assets and the liabilities? Which ones are geared highly to match the cash flow needs of the business? This is very important. And what is the aim? Is efficiency. Generally, the aim of doing this is to be efficient and to grow, and ultimately to maximize stakeholders and shareholders' value. Very important. So the reasons for corporate restructuring is drop in sales, slow economic growth or slow economy, and may involve refinancing at all capital structure levels. So you may need to rejig the equity, you may need to rejig the debt components of the finances of the business. It often occurs with operational restructuring in turnarounds. Operational restructuring in turnarounds. Very, very important. Also, the statement of financial position is a key component that this activity centers on, because the statement of financial position speaks to the assets, the liabilities, and the equity. Then also the paid up capital, talking about equity that has been paid up by shareholders, will have to be shaped up. Then paid up preference, which is a restrictive covenant in the statement of financial position, capital structure, needs to be rejigged. Various reserves, capital reserves, share premium, every kind of reserves has to be affected also. And borrowings in terms of long-term loans, debentures, bonds, short-term ones, overdraft, commercial papers, trade payables, accruals needs to be also rejigged in the statement of financial position. So companies should regularly review and restructure finances when needed to balance those driven by equity and those driven by debt, so that in days of restructuring, the value that accrues to either outsiders or insiders, outsiders talking about external providers of capital, and insiders, the equity owners, will be clearly stated. Very important to restructure finances in corporate restructuring. So that will be the end of Unit 1. And I believe you have a clear understanding of corporate restructuring from this brief introduction. So we'll be running fast so that we can, before the first break, close out on Chapter 4 so that we can move to Chapter 5 very quickly. Very interesting, but quite tricky topic. Welcome, Salma.
Can you do me a favor?
Yes, please.
Can you? So the last slide on concerning the last subject on borrowings, long term. Can you just go through it quickly again?
Okay. So I was talking about borrowing, long-term debentures, and what caused that. We're looking at statement of financial position structure. So when a statement of financial position is driven by debt or equity, it will have to be restructured to provide for the component that is to be restructured. So where equity is driving the statement of financial position more, and it culminates in slow growth, and the trajectory of the business in the past has not been moving forward. So you may need to restructure to bring in or drive it more with debt. And that includes having debentures, preference shares, allowing for external financing to re-strategize and bring the business to a positive trajectory. So the first statement of financial position culminated in this slide that spoke about borrowings. So you may need to move towards debt now. And the debt has to do with long-term loans, debentures, bonds, which are long-term, then short-term overdraft, commercial papers, trade payables, and accrued expenses. You may need to drive the business towards this area depending on its need and the analysis you've performed. So companies should regularly review what drives this aspect of liabilities, whether it's equity or debt, and to restructure the finances. But at the end of the day, what we always advocate for is balance. Make sure you balance.
Why must we have a balance? Why can't the company go more on equity, considering normally equity, the interest on equity is always lower than the interest rate on debt? So why do they have to go for debt?
Fantastic question. So there are some areas of businesses that equity may not drive the business to grow exponentially or astronomically. So for example, banking. If you take very few owners, equity owners of a bank, it will restrict their growth. But when you call out for shares, external financing, you see the bank spreads. If you look at most gearing ratio of banks, you see some 90, 80. Equity is just 20, but the bank is all over the world, all over the country. But if it's a limited bank that is not even a publicly listed bank and that is driven by equity, you see that their coverage is slimmer, is restricted.
Okay. So when you borrow more, you get more finances.
Exactly. So when you borrow money, you get more finances, and the more the finances, the more the interest, and the more the growth. And that growth culminates in bigger profitability if managed well. Look at the profit Zenith Bank and GT declared in the last quarter, all in trillions of naira. Did you see that in their publications?
I didn't go through it.
I got the alert. Man, GT Bank did a whooping 1.8 trillion or so within that range. Zenith did about 1.46 trillion.
Is that
in quarter.
net? Is that net?
Yes, net profit, not even revenue, net profit.
Net, okay. It's from us now. They are stealing our money. All those eligible alerts, they keep on, all those alerts that don't make sense. Those alerts, they'll be hitting somebody. For what basis now? They'll call it one silly name.
That's business.
They are stealing.
That's business. That's business.
CBN should check them. Can we really check it out? What business are they doing? They are stealing from us, calling it a name.
Don't conclude this year. So what we are saying is most of these banks, the equity holders are maybe 10%, 5%, even some less than. You see that they are driven. Yes, check their position statements. They're always driven by debt. But then what it culminates in is always higher. The risk and the rewards is exponential. Yes, please. I think Salma is raising her hand. She wants to shed light on this. Salma, please go ahead. You're welcome.
Good evening, everyone. Good evening, Julie.
Salma, good evening. How you doing?
I'm very well. I have a question concerning this equity of 18 because I feel like I don't know so much about shareholdings and all of that. So now, for companies, you see now, for a company that is not listed, like it's not trading its shares, you see that they have an equity, they can have shares of 40 million naira shares. So those shares, how? Because that one is just, I feel like it is just word of mouth. This person has 90% of the shares, so probably the person will have 38. Then the other 10% is shared among the board members. So I feel like these ones are just word of mouth. It's not like that money is there. So how do you now differentiate with the companies that are listed that, I'm buying 10% shares from GT? Because I have never bought these shares because, I don't even understand. So I don't buy when there is public
initial offer, yes.
Yes, when there is public initial offer and you're hearing, come and buy shares, GT. I'm like, I don't understand because I have it in my company's books and these are not like real shares. We just moved in. So what is it, sir? Please help me.
Fantastic question. So fantastic question. So now, when you talk of limited companies, if you sell shares, you cannot sell to external people. Why? Because limited companies are limited by guarantee and also limited by shares. So if you sell the shares, it's within your shareholding unit. The shareholding unit talking about the company owner. So for example, me and Julie and you decide to float a company. So I may have 90% of the shares and you and Julie have 10%. I may decide to sell 40% to you and Julie. And Julie can decide to bring somebody external and say, okay, come there's 40% you want to buy from this guy. Can you join? Let's buy and we'll be shareholders in this company. So that's just like an internal thing and it's mostly equity. You can't, in limited by shares or by guarantee, get external funding because you are limited. That's what the word limited means. So when you say PLC, listed companies, you are a listed public. So it's a public company now. You can't have, to some extent, one person owning up to 90%. It's practically impossible in a listed company. So there is dilution, there's divestment. So most of the time you see the public coming to subscribe to those shares of those listed companies. And that is why where you have 50%, 51 of one individual having control, man, the person must be stinkingly rich to be able to have that capacity and hugeness to accumulate that kind of shares. So the difference between publicly listed and limited company is the size. So that's, in answer to your question, the size and amount. So like you said, 40 million for a limited company is small, but you are talking of a listed company in 40 trillion. Just imagine a listed company having its share base in what 40 trillion naira. No, just imagine GTB now, Zenith Bank making just profit aside revenue after deduction of expenses, internal, external, organic, inorganic, and they're having profit in 1 quarter or half year for 1 point something trillion. You can imagine the size of that company. So it's the size, in answering your question, that determines the publicly listed companies and the limited by share. So most limited companies, 40 million is nothing. It's just a drop or one transaction in a bank. Just one transaction in a bank for one maybe normal customer. So it's the size that determines this share. So if you are buying shares in MTN, you look at the size of MTN. MTN has not gone public yet, but then it's a multinational. So you don't see MTN PLC, still MTN Limited, but it's a multinational that has big asset base, very big asset base. And man, if you buy those guys' shares some 5 years back, now if you look at the value of those shares for those that bought, you're already a millionaire. But if you bought it at 4 naira, now I think MTN shares is about 50 naira or so currently. So you can see in 5 years you've accumulated. So if you even sell it, you're going to make excess astronomical profit. So there are limited companies that are conglomerates, but they have wider reach. And there are some that decide not to leave the shores of Nigeria, and they are just, so it depends on the size. So look at the size of their position statement to validate your decision. I hope that covers or answers your question.
Yeah, it does, but I still need an in-depth explanation of this. Maybe I'll message so I don't slow this class down, because I literally understand the one for limited now. So basically, those shares in their books, it cannot be traded. It's just within them. They can sell within them. They can, because I know there was a time we diluted one of the board members' shares and gave it, like, we added to somebody's own and reduced the other person's own.
Okay.
I don't know what the decision was. Like, okay, the person was having 1.5, then we moved it to 1,000, then another person came up to like 700. So those ones now, it's just within them that they can do that. But for the public now, so let's say those ones that they trade, those ones that they are listed. So if I have a 5% in GT now, so it means whenever they make a profit, so they share to the share.
Yeah, so they share you 5% of the profit, or depending on what was declared in the AGM. So that your 5% shareholding now, depending on the dividend that was declared, will be proportionately apportioned to you. Yeah.
Okay.
Yeah. So, all right. So okay. No problem. You can still reach out if you have any concerns. So for each unit, if you have 5%, for example, at the AGM that dividends are declared after declaration of the profit after tax, once the policy on dividend is declared, now you're going to have proportionate to the amount of shares you have. So your dividend will accrue based on that, and it will be credited to you based on your percentage of shares owned. And that is for limited companies. So for public listed companies. So for limited companies like MTN that are conglomerates, multinationals, they also are like listed company, but then they have a particular percentage owned by the company. So for example, MTN is a South African company and they have a percentage that is owned by South Africa. Nigeria is trying to dilute it, take the ownership, but they have refused to even go public. And that's why they have a particular number of shares, and people have been advocating in Nigeria we should go for our own, go for Glo. But then Glo, so people are not taking Glo they don't like their network and some other things. They just prefer MTN, and that's why they have that control. So MTN is still limited. Why? Because they don't want to dilute their shares. They can only give initial public offer to a particular percentage, but not 100, 90, 80 like our banks and our own PLCs do. They will just say, okay, maybe a particular percentage, give it to Nigerian nationals. But this percentage, they repatriate the profit back to their own country. And that's business sense. Business sense, exactly. Okay, so we can have a discussion around this more. So we'll talk about that. Julia, is your question answered on the
yes.
Borrowings and all that? Okay, that's fine.
Yes.
All right. ACA Zakaria, you're welcome. Nice to have you back on the call. I can see he joined. Welcome, ACA.
Thank you very much, sir. Thank you, sir.
Zachariah, good evening.
Yes, ma. Good evening. How's work?
How is everything?
Alhamdulillah, ma. Alhamdulillah. How are your children? How's everything?
They're fine. You're welcome.
Thank you, ma. Thank you, ma.
All right. So let's move to Unit 2. We're looking at need for restructuring. Why the need? What's the need for restructuring a company? A company is required to strike a balance between debt and equity in its capital structure and the funding of the resulting deficit where necessary. So that's the need. Now, the striking balance does not mean 50-50. So understand the need. It may not mean 50-50. So where a company is equity driven and the company is stagnated, is making losses, then there's need to balance equity with debt. So it's not a percentage thing or a pro rata thing. It's the need. So if the company is making losses operationally, strategically, financially, then you need to mix it with debt. So the need or the balance is not a percentage thing, is a functional thing. So very important, the need for restructuring comes as a result of striking. So where a business is driven by debt and is still making losses, then it needs to incorporate equity to balance that challenge. Exactly. So that's where the need for restructuring comes. So when you hear balance, people say, should it be 50-50, 50 equity, 50 debt? No, that's not what this restructuring is talking about. So whatever mix, because the external debt and the internal equity have their own advantages and disadvantages and what they bring in to drive the business in terms of funding, size, and amount. So that's the balance that is supposed to be employed when restructuring the business. The aim is to put it back to a profitable trajectory, a profitable trend for it to make profit consistently. If it's expansion it needs, if it is getting more experienced staff, whatever it needs, let the funds, expertise, whether it's debt or equity, drive that. All the objective of this is to restructure the business to a positive trajectory. So a company will be compelled to think and decide on financial restructuring. So when it goes through, number one, when it finds out it's necessary to inject more working capital. What is working capital? Your day-to-day, month-to-month needs of running the business. So where a company is having issues with working capital, then it may not survive in the long term. It cannot meet market demands for company products or services. So working capital management is very important, and that will scuttle a business. So the need for restructuring is factored in when it finds out its working capital needs are challenging. Number two, when the company is unable to meet current financial commitments, current liabilities, long-term liabilities, the company is unable to obtain further credit because of its weak or bad credit rating from suppliers, financial institutions, then there's a need for restructuring. Very important. When the company is also unable to utilize its full production capacity due to lack of working capital. So you have assets, fixed, non-current asset, good production capacity, but you cannot produce because you don't have raw materials, you don't have inventory. Then your fixed assets are useless. And when you find this need, then it's necessary for restructuring. So these are the needs in brief for restructuring of a business. I can see Aisha is on the call. Aisha, you're welcome. Nice to have you.
Good evening, sir. Good evening, everyone.
You're welcome. Yeah, nice to have
Aisha,
you.
good evening.
You're welcome. Okay, so we are running and we are achieving, and I believe it's succinct. So please feel free to interject where you have questions or just raise your hand and I will stop. So we'll finish Unit 2 and we are going to the final elaborate unit. If you don't have any questions, can I go ahead? Are you okay with the need for restructuring? Okay, please. Yeah, go ahead, ACA. Yes, please, go ahead.
Sorry, sir, did you explain what is restructuring?
Yes, so we are done with
I'm just coming on.
Yes, you're just coming on the call,
Okay.
so you may need to go back to the recording. Yes, we are done with Unit 1. Exactly.
No problem, I'll watch, sir. No problem.
Okay.
No problem, sir.
All right, fantastic. Thank you. All right, so finally, unit 3, we're looking at types of restructuring. What are the types of restructuring? We have 3 of them, but then by way of introduction, arrangement includes changes in rights, liabilities of members. So the rights look at your equity rights, ownership rights in terms of issue of shares, the unit of shares you own. So they are rearranging it for members, and the members include equity owners. Then where we have debt owners also on the financial structure, debenture holders, creditors, and company regulations, there's a rearrangement, and that's what restructuring is all about. They rearrange it to make it more profitable for these owners, internal and external. So there are 3 types. Number 1, we have capital reorganization, then we have capital reduction, and we have capital reconstruction. So that these are the 3 types of restructuring: capital reorganization, capital reduction, and capital reconstruction. So we look at them one by one briefly. Before then, usually we used to resolve it. These 3 components are used to resolve financial distress, downward trajectory of a business, individually or combined, whether the company is a group or a single entity. Often capital reduction and reconstruction works for companies that are in distress. So let's look at capital reorganization. What does it mean? Simply, it's cancellation or substitution of a class of shares with one another. So I have a particular number of shares, let's say 20 units. So is either that 20 units is cancelled and substituted for either 10 or 15. So the value of 5 has been reduced in my own account. And it could be a cancellation of the 20, but I still have interest in the company based on shareholding. It's just that the number of units will be cancelled because of the erosion of value of the company. So you are not liquidating the business to have owners lose 100%. So it's a position where you have a little to lose, but not everything. That's what it means. So you either cancel, your shares are cancelled, reorganized to say, okay, if the value of your shares is 100 naira, sorry, because of the downward trajectory of the business is now 50 naira, and your unit is so amount. You have not lost everything. And that's what reorganization is all about. It's used to change relative rights of different shareholders classes. For example, in business combination. So where a business combines during a restructuring, there may be need to reduce the value of shares of one of the entities that combined with the other because of the value and the profit erosion of the company. So that's briefly what reorganization is all about. Then capital reduction means reducing share capital per value. So, for example, the par value of the shares is 1 naira each for that particular period based on market forces of demand and supply. So you reduce that to write off accumulated losses. So there have been accumulated losses in form of negative retained earnings. So for example, the share is 2 naira each. You may have to write it down to 75 kobo or 50 kobo to account for these losses or make up for these losses. And that impacts ordinary shareholders. It also reduces the nominal value of the paid up capital on the stock exchange. So the par value is what is entitled, the shareholders are entitled to. Then the paid up capital is what is paid up in the stock exchange. So it also reduces that paid up capital just to ensure that accumulated losses are provided for. And this is necessitated by accumulated losses eroding the company's value or significant asset value that has declined over time and needs to be revalued. So over time, you're supposed to be accumulating retained earnings, but you see some companies accumulating losses, and it keeps eroding the company's value. So what do? They have to cede some shares to make up for those losses. And that's what restructuring or capital reduction is all about. So the ordinary shareholders bear the brunt. Like Julie was saying, shareholders Why can't it be equity or equity? But then, if it's equity, they have a larger burden to bear, because once the company crashes or has going concern threats, then their value can be eroded totally. It's dangerous. That's why it's good to mix it with equity and debt, so that the weight of any issues that bedevils the company will be able to be sustained by equity holders. So the law regulating restructuring is CAMA 2004, sections 106 to 110. The Articles of Association permits special resolution by members of the board or members of the company at a special meeting. Then after they've agreed for the capital reduction, they should approve by court. So like Salman said, they were doing a restructuring and some people transferred shares from this. So it can be agreed by them in a limited liability company. But mostly for listed companies or larger limited companies, they need to revisit their MEMAT, their Memorandum and Articles of Association, to resolve this crisis. And it involves share capital, including share premium. Capital reserve is the negative of goodwill, where you have goodwill. I remember in school those days, one of my lecturers of blessed memory asked the question. He said, what is the reverse or the other side of goodwill? Goodwill is the positive brand you've built over the years, so it has monetary benefits. So where you've not built a brand positively, and what's the term? I could remember still, I think it was 300 level in school. I answered from the back, bad will. Everybody started laughing. Responded bad
But
will.
really, what's the opposite of goodwill?
No, I just said bad will. Yeah, so
But again, goodwill.
no, it's not goodwill. The negative of goodwill is capital reserve. That's what it means. So he explained capital reserve and it's stuck since then. Yes. So capital reserve means you accumulated negativity in form of amortization or intangible assets. So when you don't have goodwill, it's called capital reserve, and capital reserve is negative to the company. So that's how I understood capital reserve. A lot of people don't understand. Oh, they didn't teach you that one? Oh, really? That's what capital reserve is about. So if you see... You said what?
Huh?
Sorry, come again,
I'm
Salma.
telling Julie that they taught us. She just have forgotten.
They didn't teach me. I can't remember capital reserve.
When you check accounts, there's always that capital reserve there. Maybe we did not know what it truly meant.
Yes, so that's the negative of goodwill. So if you don't have positive goodwill in a consolidation account and you see capital reserve, you just know the positive company doesn't have tangible assets. It's negative. Capital reserve is negative.
We've not reached that level because we are doing consolidated accounts now. So maybe we've not reached that level yet. Yes,
maybe you've not reached that level. So I learned that in school. I think it was 300 level, something on group accounts or so. We learned that in school. Okay, so so the share capital, the share premium, and the capital reserve will have to be approved by court for it to be tampered with. So the ways to carry out this is to reduce or annihilate, extinguish totally the liability on unpaid share capital. So whoever owns, or the company shareholders that own that, will have to let that go. That is gone in their value proposition. So they repay excess capital with or without reducing the liability. So the general impact or outcome falls down to ordinary shareholders. They may have to lose some of their shares. It may not be everything in the restructuring process. And that's the painful thing. Like we always spoke about that. Why are ordinary shareholders always carrying the burden of any issue with the company? You share profit, you must give external first before them. But then those are the hard truths of business, or the hard outcomes of business. They bear most of the negativities when it comes to downward trends of the business, and they also bear the positivities when profit is declared heavily for a company. So they repay excess capital and reduce the liability that the company has been bedeviled with. Also, cancel lost unpresented capital with or without reducing liability. So the lost capital can be cancelled without reducing the liability. This area of restructuring is important because once you've lost your capital, if the liability is still there, then they may have to touch some of your assets, some of the company's assets to offset some liabilities, especially if they are debt driven. So the restructuring process can be painful, but then it's with the aim to get the company on a positive trajectory. The court protects creditors, and that's where it's painful. Creditors talk about external finances, financiers of the business. Dissenting creditors usually paid or secured. Preference shares, debenture holders, long-term loans. These ones are protected. The court grants that protection that they must be settled first, which allows a company to show a more realistic financial position and distribute future profits without covering past losses. So once you've settled creditors, the remaining amount, if it's positive, will be retained by the ordinary shareholders. So because the creditors have fixed this amount, they are not the owners of the business. They just provided you capital with interest, and the court protects them in karma and every business. So they come first when issues of restructuring are calling on the business. So the simplest method in restructuring is to proportionately reduce the nominal value of outstanding ordinary shares. So we've spoken about that. The par value is where the value proposition is for the company. So you bought your shares at 1 naira each, and you've grown it to 4 naira. Painfully, during restructuring, that 4 naira, if you've not sold your shares, will have to come down. And that's why some people who buy shares and immediately it grows to a particular amount, they just call stockbroker, oh yeah, sell the shares because I don't know the future. And that's the challenge of businesses. So one has to forecast and be very smart in his investment decisions. So the simplest method is to reduce nominal value of ordinary shares, no change in the real shareholders' interest, but then the outstanding shares generally will be reduced. And the formulation principles include ordinary shareholders bear a greater loss. Exactly, we've spoken to that. They bear a greater loss sincerely, even though they retain their interest, but the value is always eroded. But then it's better than losing 100% in cases of liquidation and bankruptcy. So fixed interest security holders should not be worse off than in liquidation. So fixed interest security holders like debentures, term loan, preference holders are ensured that they are not worse off if the business closes. So if the business is able to shut down, the remainder of the assets, they'll first settle them first. So it's possible ordinary shareholders don't get anything, but they must settle fixed interest security holders. That's in worst case scenario of bankruptcy or liquidation. And the essence is to ensure that they protect fixed interest owners. Also, for preference shares, they also consider those with loan stock that have taxes or leverage. Preference shareholders are also considered immediately after debt owners. They also consider raising additional capital through rights issue and also sometimes bonus issue, so that they can settle fixed interest debt owners and also preference. So not to add value to ordinary shareholders, but just to close out and make sure those restrictive rights or covenants are fulfilled. So preliminary computations for capital restructuring, we look at the total losses first. What is the loss, accumulated loss, and what is the assets value? So those are the first computations when you are doing that. So if you see a question, the first thing you should look at on capital restructuring is what losses have been accumulated over time. So instead of retained earnings now, you'll see loss. So you look at that, then you check the asset value. What are the value of your non-current and current assets, the total assets? Then you discharge next is to discharge the claims based on the liquidation priority. So you prioritize fixed interest first, pay them off based on what your asset remains. You pay off preference, Then the remaining balance, you give it to ordinary shareholders if there is. So those are the preliminary computations you compute. So the first priority on the order is fixed charge creditors. Then you pay liquidation costs. What is the cost? You may need to employ a liquidator, a receiver. They call them receivers and liquidators, or liquidators. You may need to pay their cost after you've paid fixed charge, debenture holders and co. Then you may need to work on preference shareholders, the third. This is the order. Then also floating charge holders. Floating charge holders are another set of preference shareholders. They are not direct preference shareholders. They may be cumulative preference shareholders. Those are floating charge holders. They have classes. So they come under preference shareholder creditors. Then we have unsecured creditors, another set of creditors that are not floating charge. Then we have contributories. That's the shareholders. Preference usually come before ordinary shareholders. These ones are the last. CAMA 2018 removes irredeemable shares. So there are shares that are irredeemable. So these ones are not prioritized during liquidation. But redeemable shareholders are prioritized, and they are the ones that are floating charge holders after preference shareholders. So the last is always shareholders, owners of the company, that bear the cost. So we formulate a scheme based on losses absorbed by contributors. That's the owners of the business. We summarize that scheme and we revise a statement of financial position based on that. So there's an example in the study text, ADEX Nigeria Limited. So it has a comprehensive solution. It shows how the first step to calculate capital reduction needed to eliminate losses and write down assets. So the ordinary share capital is reduced proportionally based on the losses. So look at the question, because he tested capital reduction, this subject or this topic, once in the 21 diets. He has tested it once. So we don't know whether he will test it. So in one of your practice sessions, just test this question. It's simple. ADEX Nigeria Limited is in the case study text. Just test it. Look at the capitulations, how the losses were shared among preference, the shareholders, and those that are the financial structure of the business. So just test it, play around that question. And yes,
sorry. ADEX Nigeria. Oh yes, ADEX Nigeria. Okay,
no, it's not a past question. It's in the study text in this capital restructure. Okay. Yes, please. Yes, it's in the study text. But just open the study text, you'll see it, chapter 4. The first question, there are 2 questions there. So this is the first one. So play around it. The question is there and the solution. We don't have time. We'll have looked at it on the call, but we don't have time. So just look at it. If you have questions, please chat me up and I'll respond to any computations on this. Okay, so the first thing is share premium. Share premium is usually the first to be written off. What is share premium? Share premium is any addition in value that the ordinary shares have accumulated over time. So it's the first thing to be written off. And preference shareholders' par value often remains to protect dividend rights. Exactly. So these ones are restrictive covenants. They have that protection. They have that protection. Very important in reconstruction and capital reconstruction or capital reduction. So finally, capital reconstruction is applied when the company is severely in financial difficulty and needs to reconstruct its financial position. It often involves capital reduction and is an alternative to liquidation. So the reason for capital reconstruction is so that you don't liquidate or file for bankruptcy. That's the essence. So you need to reduce your capital and reconstruct the business, restructure the business. So asset value may be less than the liabilities, which is a critical case, where liabilities are more than the asset value. There needs to be an agreement between the debenture holders and the creditors on the liability treatment. So creditors, people that provided loan or finances to the business, then debenture holders, covenants, we need to strike an agreement to share the remaining assets based on the liabilities that is on the asset, on the position statement. There also needs to be an achievement of economic viability and profitability, and that's the essence of capital reconstruction. So they need to achieve economic viability, reduce the value of the asset, reduce capital, then aim to do better in the business space. It may also involve raising new capital through rights issue after writing down capital to make the shares attractive for the company. So these are the processes of capital reconstruction. And also the removal of losses from the statement of financial position in form of retained earnings for earlier dividends is very necessary. So when you write down or reduce the capital, the ordinary shares of the business, it goes with the losses, and you go back to ensure that the business is doing well on a positive trajectory. So what are the types of capital reconstruction? Number one, internal. So there's internal reconstruction, and it has to do with no liquidation. So when you are restructuring internally, you don't liquidate the business. You try to reduce your capital, reconstruct everything that is within the capital structure, and you are not liquidating the business, which is good. Then the external reconstruction means another company takes over your company. So there's a takeover, and the old one winds up. And most of the times you see where losses are accumulated by a company and another company comes to buy that brand, they take over the brand, they don't match, they absorb, they just swallow the company, buy it off, retain the management team they want, and sack the other ones and absorb them based on their capacity. So that's external reconstruction, and some shareholders of the old company may be paid off. For internal reconstruction, it has to do with no liquidation, no absorption, but then there's reduction in value of the company. So capital reconstruction scheme is a situation where it's an alternative to financial distress. Instead of closing down, you reconstruct to go up or to do better. Also, the liquidation outcome influences this scheme design and evaluation. What is the liquidation outcome? Everybody loses 100%, and that's the fear. You don't want to lose 100%, so you reconstruct to see if you can refire and do better in the business space. Also, distribution of liquidation. If it culminates in this liquidation, is a bit serious, because you employ a liquidator to sell the assets and pay in this order, like we looked at. You pay fixed charge debt, those that have fixed charge on your assets. After you sell the assets, you must pay them first if it's a liquidation situation. And this must be avoided in capital reconstruction. And that's where the need for internal reconstruction comes in. You must pay fixed charge debts first, the debenture holders and all those restrictive rights, and appoint a receiver. The receiver treats the deficiency of the company, pays secured debts and unsecured, also takes away his liquidation costs. He settles creditors based on the Solvency Act of 1986, removes payee, pension, employee, emoluments with limits though, and he also pays the remainder to the unsecured. The next people he pays is floating charge creditors. He also pays unsecured creditors before coming to contributory. So this situation is to be avoided, and that's where the need for capital reconstruction comes in. And finally, shareholders get the remaining piece of cake that has been shared. So if insufficient funds in the group culminates in each member receive a proportionate amount, that's if they get any amount. So reconstruction is very good. It's redesigning a capital reconstruction scheme. The objective is to create a profitable going concern. And the aim of liquidation is to halt the going concern, is to cut off the going concern of the company, and that should be avoided. So the essence of reconstruction is to improve and regenerate a profitable going concern. Severe difficulties may make this impossible. So less severe issues like having success probability could enforce this. So usually it requires relieving immediate debt burden That's what reconstruction is about, and raising new finance to kickstart the business on a new trajectory. And that raising new finance could be through share issue to the public. So affected creditors, restricted shareholders' right requires necessary vote majorities and court sanctions. So where issues like this come in, the court will come in to rule where the shareholders have taken the matter to the court, and the court will provide a scheme of events for each party, at least what they will get in liquidation. That's worst case scenario. And that is why reconstruction is a good option. And the court will ensure it's fair and equitable, treating all classes of financiers of the business fairly. Also combines the capital reduction and reconstruction to write off losses and write down assets. So in evaluating a capital reconstruction scheme, the aim is to establish relative fairness and equity of charges or changes in right. Also have professional advisors often evaluate for each class of assets, each class of finance. It also requires evaluating the scheme as a whole due to changes in relative rights, capital repayment, and income participation. So we compare the interests of parties before the reconstruction and after to see how everybody will be better off after the reconstruction. So there's also the second example. This one is a bit technical, but then please look at it in the study text on capital reconstruction. The first one is on capital reduction, and the second one is Stadex PLC on capital reconstruction. Please look at it in this case study text and just play around that question. The solution is also there, so it's not that it's not there. It's there, step by step, on how to answer the question. On a proposed scheme by comparing liquidation outcomes before and after with a potential future earnings under different scenarios if capital reconstruction is done. So consider the impact of banks, that's the cash at bank, cash in hand, debenture holdings, trade creditors, preference and ordinary shareholders. So the goal is for all parties in the reconstruction to benefit or at least be not worse off than they were before the liquidation and to gain their agreement. So I've eaten into our break time by 4 minutes. I don't know if we can go to our quiz. We are done with this unit and we have also ended chapter 4 very, very fast. So do we go for our break before we look at a quiz question? What do we suggest? We can do the quiz in 5 minutes, or maybe when we come back after the break, take our eyes off the screen. What do we suggest so that we can do our 5 quiz to test ourselves? What do we think?
For me, I think we should do the quiz so we can resume a new chapter or a new section when we come back.
Yeah, so I think so too. But let's get the concurrence of others. ACAs, what do you think?
This quiz, you take all the marks today because this topic.
I'm telling you, honestly, I sleep even came. So I don't know this
quiz today.
And when Julie is talking about sleep now, that's when she will score 100%. You'll be surprised. That's
Amen. Let's hope so.
No, I don't want 100%.
It was very technical.
I'm always jealous when you guys score 100%. I don't like it. I don't like it at all. Okay, so since we are agreeing to go for the quiz, then let's do it. Let's do it. So ACA Zakaria is not used to our quiz. We normally do quiz after every session to test our understanding. It's multiple choice questions. So let's test our understanding. Yes. So you just tell us your option when we show you on the screen, and that's how we do it generally. So we have 5 questions. After that, we'll go to Judgment Day and see how we did on our result. So some people are always targeting 100%, and I don't want them to score 100. That's my own target. 80, 60 is okay for you. But then some people are always aiming at scoring 100, and I don't like it. Okay, so I have J, I have S, I have Z, and I have E on the call today. Okay, so chapter 4. All right, so let's go to the questions now. Number 1, which of the following is not a typical trigger for corporate reconstruction? Which of the following is not a typical trigger for corporate reconstruction? A, loss of market share. B, weak brand positioning. C, increased profitability. D, inability to retain talent. Take note, which of the following is not a typical trigger for corporate?
C.
Yeah, J said C. I had S to say C. Okay, so Z, what's your pick? A, what's your pick?
C.
The A to pick C. All right, Z, we are waiting for you. Even though you are not in this, you are not in the first unit.
It should be increased profitability, sir.
Okay, C. Z is speaking C.
I think it makes sense.
Okay, everybody is speaking C. Well, we'll see. And judgment B. Oh, you are changing your mind to C.
No, I'm not. It's C.
It's C.
No, it's C. It makes sense.
Okay.
It makes sense.
All right, we'll see. Number 2, in the context of financial restructuring, what is the primary aim of a scheme of arrangement? A, reducing production cost. B, avoiding taxation through revaluation. C, matching liabilities to cash flows. D, expanding market operations. In the context of financial restructuring, what is the primary aim of a scheme of arrangement? I like this one. This one is a bit tricky. A, reducing production cost.
I didn't remember seeing scheme of arrangement during the program.
Interesting. That means she's about to give me Somebody is speaking deal. Julie is about to do giveaway. Julie is about to do giveaway for me today. Yeah. You guys should make a pick. In the context of financial restructuring, what is the primary aim of a scheme of arrangement? A, reducing production cost. Okay, S, go ahead, please.
C.
You take
C.
C or D?
What?
C for cat.
Okay, S is picking C. All right. It's like Z. You're trying to say something.
No, I'm not. I'm sticking with my D.
Okay, Z is going for D. All right. J,
I go for C.
Away for me. J is going for C.
I go for C.
All right, so we are waiting for A now, even though she was not in this lecture section. But the A, you may have to guess. So. You came in late. A, we are waiting for you.
I'll go for A, reducing production costs.
Okay.
Wait, I think it's T.
J is changing her mind.
Under markets operation.
J, final answer, D or C?
D.
Are you sure?
Yes.
Okay. D, S said C, Z said D, and A said A. Okay. We'll see on Judgment Day. Number 3, under CAMA 2004, section 537, which of the following is not listed as a type of financial restructuring? Come on, this one is simple now. How about A, capital reconstruction, B, capital reorganization, C, capital distribution, D, capital reduction? How about
capital distribution?
Why would I say this question?
Absolutely, C, sir.
Okay.
Absolutely, I like that.
I don't like this question.
That order would I would just pass. It's not that D. Gaskiya.
We have gone back. So you are free to change.
It has to do with finance, not marketing. It's okay. Let's go.
No, you can change. We have not seen the answer yet. So what's the answer? What do you think? You can change.
Don't worry. Let's go.
Do you know he was even on my mind because I wanted us to go back to it self. But I just said, let me just keep quiet.
No. I'm back to it though. I want you guys to do giveaway for me.
Okay.
Group giveaway. Oh yeah. Change it. What's your answer? Z said D. So what are you changing it to? J, what are you changing it to?
That's
in the context,
your D. I don't know.
I'm picking A.
Z is going for A. Is going for A. All right, J. Z went from D to A. Are you going to A too?
No.
You must do giveaway for me today, whether you like it or not. Nobody will score 100%.
I think okay. Expanding market operations is okay.
You're sticking with D.
Yes, it appears so. I'm still looking at it.
Okay, she's sticking with D now. Let's go because of time. Number 4. What is
let's go.
Okay, number 4. What is the key condition required before a company can carry out capital reconstruction under CAMA? A. CEO's written approval. B. Audit committee endorsement. C. Shareholder resolution and court approval. D. Approval by the company's consultant. What is the key condition required before a company can carry out capital reconstruction under CAMA?
C.
S, C, A, C. Okay, we're waiting for J and Z now.
C.
Okay, J is going for C. I know Z may want to follow the crowd, but if you follow the crowd, you may jump inside the rally with them. You're actually in this class, so you should get this one, Z.
Carry out capital reduction under CAMA. Okay.
Is he awake?
Let's go, sir. I'm helpless here. Let's go.
No, you have to pick. Either you follow the crowd or you change your mind. We are not going. You must pick one. Whether you guess or you follow the crowd, anyone, you must pick one.
Crowd is saying C, go.
And the crowd said C. So
let's go. C is okay. Let's go.
So if everybody failed, just know you have failed with them.
It's okay, sir.
Exactly. So finally, what is the main objective of designing a capital reconstruction scheme in the case of a financially distressed company? What is the aim? What is the main objective of designing a capital reconstruction scheme in the case of a financially distressed company? A. Liquidate company assets as quickly as possible. B. Convert all shares to preference shares. C. Create a profitable going concern. D. Shift operations to another industry. What is the main objective of designing a capital reconstruction scheme? Who is that? That voice sounds like J.
J.
Okay, J said C. Okay. That was so fast. All right.
I might change it, but let us see. I think C for now.
Okay. What is the main objective of designing a capital reconstruction scheme in the case of a financially distressed company? Liquidate company assets as quickly as possible. Convert all shares to preference shares. Create a profitable going concern. Shift operations to another industry. We're waiting for S, Z. The S is going for C too. Okay, A is going for C too. A, did I hear you?
No, not but it's C, but you didn't hear me.
Oh, okay. I thought you spoke.
I'm going for C too.
Okay, so our last ACA is standing. Last ACA standing. We're waiting for you, Z. What's your pick, Z? You're muted if you're speaking.
Okay, sir.
Yeah, so what's your pick? What's the main objective of designing a capital reconstruction scheme in the case of a financially distressed company? Liquidate company assets as quickly as possible. Convert all assets to preference shares. Create a profitable going concern. Shift operations to another industry. So if you want to follow the crowd again, the crowd went for CC.
Let me make my choice here.
And Jay, you can still change your mind though. You say for now it's C.
No,
so
okay.
You're not changing your mind.
He wants to threaten me, but I refuse to be threatened with
C.
Okay,
I'm going with C.
Okay, you're going with C. All right, that's good. So let's go. Judgment day now. Let's see our answers. Number 1. Which of the following is not a typical trigger? Huh?
The drum roll.
Yes, drum roll. Thank you for that.
I've been
Thank you for that, Jerry. Number one, which of the following is not a typical trigger for corporate reconstructuring? The answer is C. Wow, everybody got it. C. So increased profitability is not. The explanation is that corporate reconstruction is usually triggered by problems, not success. Exactly. Increased profitability is a sign that business is doing well and doesn't need reconstruction. Okay, that's good. We understand that. All of us got it. Number two, in the context of financial restructuring, what is the primary aim of a scheme of arrangement?
Hey.
J failed it. C. S.
Oh,
Only
my
S.
goodness.
Only S got it. So J, thank you. Thank you for the giveaway, J.
You
Z,
know when I saw that
for the
liabilities,
giveaway.
you know when I saw liability, you don't indicate whether it was current liabilities, because that's why I was a bit confused. Because current liabilities are what I used to match cash flows, you know. So
Exactly. So that's why it was.
but you just wrote liabilities only.
Sorry,
You know,
Salmat is
the
trying to speak
scheming,
to that.
I know the remaining, I don't even know the other types. I shall remember this rearrangement. I know it's to match your, like, it's to check whether you'll be able to pay what not.
Pay
So I
up.
could remember that
Exactly.
the word match.
Exactly. I saw what that's about. He did not indicate current liabilities because because no cash flows cannot match up with long-term liabilities, you know. So
Thank you for that giveaway, even though you now know.
So you cheated. So you cheated. You didn't give us correct answer. You didn't give us the detailed answer. You should have written current liabilities. So current liabilities are what you use to match up cash flows, not long-term liabilities. So you cheated, sir.
I didn't cheat. I was teaching good. So you and Z and A gave me. You people did give away. Thank you. I appreciate it.
It's okay. It's fine.
I'm smiling to the bank. I'm smiling to the bank. All right. So the answer is C. A scheme of arrangement helps restructure a company's finances, especially during distress, to make sure it can meet its obligations in line with cash flow. So let me see the picks. J picked D. Expansion is a growth strategy, not a restructuring focus. Exactly. Then Z and A picked A. A is reducing production cost is more of an operational restructuring goal. So thank you guys for the giveaway. And number 3, under Kama section 537. Which of the following is not listed as a type of financial restructuring? The answer is C. Wow, everybody got it. That one is even simple, sir. So, number 4, I like this. Everybody too got it. C. Okay. Number 5, everybody got it. C. Who is going away with 100%? S. Salma is going with 100. This is not good. J, 80. Thank you, J. Z, 80. You gave me at least C, A, 2, 80.
Put number 4, please. I want to see number 4.
Yes, S had 100 now.
S had 100. S, why now? Why did you do this to me?
I needed to show for J.
All right. Okay, so we are back to number 4.
Okay. I wanted to say it because I remember when we talked about you used my example to make an example here where you said for limited, they just for a small